Okay, so just as I'm saying, I'm going to basically start now. If anyone's got any sound issues, just let me know. But there's not really a lot I can do about it. It's probably got to be something at your end, I would think, unless it breaks up at my end. Okay, so what we're going to look at tonight, and basically the start of this these once a month webinars, I'm going to go over different elements of market strategy and the way I trade, a little bit more detailed than the free webinars. And what we're going to look at tonight is basically what's going on behind the scenes, what's actually happening in these markets, and how can we identify what's happening, who's doing what, and how can we most essentially profit from this. Now, the first thing that I wanted to start off by saying is just clarifying one of the issues that a lot of people get confused with, which is this whole concept of when markets move up, there are more buyers than sellers, or when markets move down, there are more sellers than buyers. I think it helps to think of that in a different light. Okay, it's not really the number of participants that really move the market, but more the desperation or the urgency with which people are basically seeking a transaction or trading. And I want to give you a couple of examples of this. It's maybe a little bit boring and also a little bit obvious, but just to clarify the points. If you take, for example, let's say we've got a valuable car auction. You can't see anything on the screen at the moment. If I was a real legend, I would have done a nice little presentation of a car, etc. But just run this through in your head. If you take, let's say, a valuable car auction, and I don't know, maybe they're auctioning off James Bond's Aston Martin from the films or something, and you've got loads of people competing to try and buy this car and take ownership of it. Obviously, you've got one seller and a huge amount of buyers, right? You've got one guy selling the car, loads of people that want to buy because it's a popular car, and there's collectors and people that are just rich and interested, etc. Now, basically what's going to happen is that they're going to try and outdo each other to try and get that car. So as they put in bids, it's obviously going to go to the highest bidder. The transaction is going to take place with the highest bidder. So basically, price is going to move up as people get more aggressive and try and outbid each other, and the value of the car rises. Eventually, it's going to go to one person. But what you've got to also remember is that as that price is going up, some of the bidders, okay, are going to drop out. Some people are going to get to a point where they think, well, I'm not paying this. I wanted this car, but it's simply getting out of my reach now, and I'm not going to pay this amount of money for it. And obviously, what's happening at the same time is that there will be other people that will take time to consider whether they actually want to pay more. They may still be in the running, but they're going to take time to consider. And so often what you see in the markets is you can see sharp run-ups in price, and then you see sideways consolidation areas where people are digesting what is happening. They're digesting current value, deciding whether some of them want to drop out or take more time to consider, and then often you see breakouts and trend continuations. Okay, and that often manifests itself as kind of like this whole zigzag pattern that we see in markets, where in financial markets, where buyers come in, some buyers take profits, other buyers buy on dips, and the market moves up in that kind of formation. Now, let's take that example and flip it on its head, because in that example there was one seller and loads of buyers. So actually the price of the car was going up because there were more buyers, right? But let's flip that on its head. Let's now say there's two examples, two sellers of that car, okay? And basically they've got two exact same copies of the car, and they want to sell it, but nobody actually wants to buy. We're in a recession. Nobody can afford to buy this particular car. Maybe some of the people that can afford it don't even know that the car's for sale. And what you're going to get in this scenario, okay, is that basically the buyer in a way is in control. Okay, so the buyer's going to hold out until the sellers bring the price down. So in this case, there might actually be more. There might be more people that are generally interested in buying, but they're going to hold back, okay, because maybe for that particular time they don't really want to buy. So the sellers are going to have to bring the price down to try and find a buyer, right? If they need a buyer, they're going to bring that price down. So what's happening is markets are really always trying to find value. Okay, and I don't know if any of you guys have seen when a spread widens during a transaction. So maybe you're looking at a market, whatever it might be, and you sometimes notice, particularly before news, that spreads widen. And what's happening here is that, let's say you've got non-farm payrolls about to come out. So it's a big bit of news. What you're going to see is that the buyers and sellers, okay, might be taking a little bit of a step back from the market because they don't know what's about to happen next. So the offers might be stepping back a little bit, moving a little bit away from the current price. And the buyers might be stepping back as well. They're waiting to see what happens. And so as those bids and offers pull back from the market, because they don't know what the number is and there's uncertainty, then the spread obviously between the bid and the offer widens. Now, if you think of this in a financial market transaction, let's suddenly say that there's the buyers waiting on the bid to see what the non-farm payrolls is, and there's the sellers waiting on the offer to see what it is as well. Let's say it's a terrible number. Okay, it's a really, really bad number. Well, what's going to happen, right, is that the buyers, probably the quick-thinking buyers, the first thing they're going to do, right, is they're going to move their bids back because they don't want to buy because it's a terrible number. So they're going to move their bids back very quickly. Now, what happens here is that the sellers, because they have to transact with a buyer, if all the buyers move their bids back, then the onus is on the sellers to basically pay down and accept a lower price. So sometimes you see these sharp erratic spikes on news because the sellers have got no choice. If they want to short that market, or perhaps they were long and they want to get out of a position because it's a bad number, they've just got to accept the first price that a buyer will be willing to give them. But obviously, as we've seen, the buyers are thinking, well, I'm not buying anything here. It's a terrible number, so they pull the bids back. Now, I don't know whether you guys have followed me or not so far, but the reason why this is all interesting is that basically markets move, okay, when people are either forced to make a decision, all right, or they're using emotion to make a decision. Okay, so what I want you guys to try and do, I'm displaying a chart at the moment, and now I'm back to the whiteboard. What I want you guys to try and do is to try and profit and to try and see this stuff happening in real time, is trying not to look at the charts as just price movement, just candles going up and down, but try and think of it as traders making decisions. Okay, and what we're going to try and do is try and isolate areas when they're in pain, okay, or when they're feeling greed. And I always relate this story that I had from prop trading, which is when I first joined prop. One of the big traders there was asked to talk about his strategy and how he trades and how he makes money, and he stood up at the front, and we were expecting some kind of, I don't know what we were expecting. We're expecting maybe he used a certain indicator or he looks for a certain thing, and he stood up there with a big smile on his face, and he basically said, well, I try to find people that are in the shit and I try to make money off them. And that was pretty much what he said, and we all kind of thought, well, hang on, that sounds a bit cryptic. But when you think about it, some of the best moves in the market, some of the sharpest moves and the best profit opportunities come from other traders that are stuck or other traders that are trapped, and they're having to make a decision to bail out of that market. And I'm going to show you some examples of this on charts now. So let's flip back to this chart here. Now, this is basically the New Zealand dollar against the US dollar, and it's on an hourly time frame. Now, just to clarify a point, a lot of people say to me, what time frame should I choose? Should I trade a 4 hourly? Should I trade a 1 hourly? Etc. And I think that the market patterns are pretty much fractal. What you see happening on an hourly chart, you often see happening on a 15-minute chart, on a 5-minute chart. At the end of the day, the charts are really just a window to watch the market. If you think about it, we might put emphasis on hourly closes, but the market doesn't close and reopen every hour. Okay, it's the market movement is constantly fluid. It's constantly moving. There is no open and close. It's just the market on an hourly chart is broken down into nice little chunks that we can try and digest, and it's like I said, it's our view, it's our window for viewing the market. Now, what I wanted to go into, in fact, before I put a chart up, let's draw something on here which I think will kind of illustrate the point. Now, obviously, in a market, when a market's moving up, okay, it moves up, it pulls back, it moves up, it pulls back, so on. That's the kind of definition of an uptrend. Okay. Now, if you think about this, the definition of an uptrend, what makes this an uptrend is the fact that, and one of the facts that makes it an uptrend is the fact that we are making higher highs. That's what you'll see people often relate to and often talk about. The market is making higher highs. Sure, it's making higher lows as well, okay? But what I want to focus on for the time being is that the markets are making higher highs, and that's the definition of an uptrend. One of the first things to think about is that when a market makes a higher high, people are forced to make a decision. Okay, as the market makes a higher high, traders are forced to make a decision. What kind of traders are making decisions as the market makes a higher high? Well, people that are short this market, expecting it to go down. Maybe they thought this was the top. Where do they usually put their stop? They usually put it above the swing high. It's probably the most common stop placement out there. They put it above a swing high. So if the market moves up to a swing high, what's happening is that these groups of traders that shorted are thinking they're wrong. Why? Because the value of the market is moving up and it's confirming that this wasn't the last high. What's also happening is, while this group is realizing that they're wrong, there's another group that have read the textbooks and know a bit about market theory, and they think, wait, hang on a minute, we're making a new high. And if we're making a new high, then the market's in an uptrend and I'm going to try and be a buyer. So it's when you get to swing points that you get to decision areas. This is one of the first things. It's very basic. This is one of the first things they taught us in prop. Know where your swing points are. Where are your daily highs? Where are your daily lows? Where are your weekly highs? Where are your weekly lows? Because they'll usually be on a lower time frame. They'll often be swing points. Okay, and at swing points, traders have to make decisions. Okay, now. When a market, so you get a kind of value at swing points, and what you sometimes get, and I'm just going to bring up a new chart here, or draw a new chart I should say, sometimes you'll get swing points, multiple swing points in a certain area. So you'll get a swing point like this, okay? This is a resistance level. What's unique about this is there's a lot of swing points at approximately the same area. Now, why? And I know that this is really basic, and some of you guys are thinking, well, where are you going with this? We know all this. But what you again want to think about is what some of the traders, other traders, are thinking about in this particular market. The more that there is swing points in a certain area, the stronger the level. The stronger the level, okay, certain things are happening. Number one, as the level gets very, very strong, there are a lot of traders that are taught that what they should do is they should sell. Okay, they should sell it there because it's been a multiple confirmed resistance. I always like to go back to that post on Forex Factory where somebody wrote, that was why I don't like support and resistance, because I learned that the more that the market hits an area, the better the level it was, and every time I tried to sell it there, I got blown out of the water. Okay, now that was you, Gary, and why is that actually happening? Because the sellers that crack it here and they get short, where are they going to put their stop? Well, the obvious place for a stop is going to be somewhere above these bar highs. It has to be. It might be the last swing high before we got down to that area. So if the market looked like something like this, it might just be up there, but it's going to be somewhere above that buy area. Now, obviously, the longer that there's been resistance here, what else is happening? Okay, what else is happening is that there's loads and loads of orders stacking up to go long, because what's the other popular strategy on the internet and that many traders do is they buy breakouts. Okay, in fact, a lot of people straddle a trading range like that. They put a buy order there and a sell order down here, and they say whichever way it goes, I'm joining the momentum and I'm going to get in, whether it goes up or whether it goes down. Now, let's take this one step further. What's happening here, okay, is that there's loads of orders building up. Okay, all the orders that are building up on the upside of this range are buy orders. Now, it's a moot point, but an interesting thing about this is that although these are all buy orders, the traders are doing different things. The shorts are stopping out. They're actually losing money. Okay, so they're buying back their shorts, but they're still losing money. They're buying back their shorts for a loss. Then you've got the buy orders that are just getting in. They're not losing any money. In fact, they're just jumping into the market on the breakout. They're all buy orders, but the traders behind them are doing different things. Now, what does all this mean? Well, it means that what you get are kind of what you should think of as liquidity pools. Okay, you get these areas where if the market moves to that area, there's a lot of liquidity. There's a lot more buyers. or there's a lot of buy orders coming in there. There are a lot of buyers hitting the market. So these areas are where professional traders know that there is a large amount of liquidity. Now, I'm going to take you to an example that I actually saw in prop, and I saw some of the big guys do this in prop. And again, I've talked about it before in the free webinars, but we'll just go over it briefly now. Let's say you've got a trading range. Okay, you've got a trading range, the market's floating. Whoops, let's move back to this. Okay, you've got a trading range, market's moving around like this in the trading range. Okay, so what's happening is all the buy orders stacking up here. Okay, for people to buy the breakout, people to stop out if they sold perhaps this last high at resistance. And you've also got loads and loads of sell orders down here. We know that for a fact. The longer the range, the more orders that build up. That's a fact. Okay, because the more it's been noticed, the more people are likely to trade the breakout, the more people are buying support who stops beneath here. So the longer the trading range, the more violent the potential chance for a move because of all this liquidity that's building up right here. Now, I actually saw somebody once in prop that wanted to actually buy. He was coming down to this area here, and he wanted to actually buy the market because he thought it was going to go up that day. But he actually began by selling. Okay, note this. He wanted to be a buyer. He started off selling. Now, why? Well, basically, because if you think about it, he's a big buyer. All right. Now, if he starts buying, a lot of people that use the order book are going to, most of the time, see and notice a big buyer buying. And if they notice a big buyer buying, a very popular strategy when you've got an order book is to try and follow that buyer, to front run him. If you've heard that term front running before, that means get in front of him. If you see a big buyer, you jump in front, knowing that that big buyer is going to come after you and buy loads, then you're going to get, the market's going to move up. So the big buyer jumps in and he's buying massive amounts, and he's going to get people joining him. Okay, so what's happening is there's other buyers, people buying because they see him buying off the order book, right? Now, what about people that haven't got the order book? People that haven't got the order book look at the chart and they go, bingo, support level, and it's bouncing, I'm going to be a buyer, right? So what does this mean for the poor little professional that's tried to buy it here? It means that he's got a shitload, excuse me for the language, he's got a shitload of buyers and probably not that many sellers. He's got everybody basically trying to join the bid with him. Now, a professional doesn't want to be buying when everybody else is buying. Why? Because it's going to push the market up on them. If they've got to buy 1,000 contracts in the DAX, for example, which is quite a thin market, ideally they want it over one or two prices. They don't want to be filled, finally get their 1,000 lot on when it's all the way up here. They want to basically buy it where they first wanted to buy it. So if all the other buyers are joining in because they see support or they see this guy buying aggressively through the order book, they're all going to be joining, and it means he's going to start to get slipped, and it means that he's going to pay up and he's going to establish his position at a much higher price than he wanted to. So what does he need? Well, he needs a lot of sellers, right? If he gets a lot of sellers, then he can buy as much as he wants without pushing the market up on himself. So you look at that example and you think, well, how does this guy get a lot of sellers into the market? Very, very simple. He pushes it down. Okay, if he pushes it down here and creates a breakout, then he gets all the shorts in. All the shorts start to come in for the breakout. Everybody that bought the support down here stops out. And hey presto, a lot of selling hits the market. This guy can accumulate everything he wants. Okay, as he accumulates everything he wants, what happens is his aggressive buying starts to push the market up, okay, and back into the range, creating the false break. And this happens quite a lot. Being in prop actually put me off trading breakouts for life. I used to trade them, not avidly, but I used to trade a fair few, and it really put me off them because you saw the pros basically playing these games, and you see it happening time after time. Now, let's flip back to a chart now, and I'll show you this, an example, exactly what we see here. Now, if you look at this example here, we've got a solid resistance, okay, in the New Zealand dollar on the hourly chart. So we've got a lot of sellers that have dominated up here, and they've kept price pushed back. Okay, we've created these two highs. Obviously, where you exactly draw the level, I tend to draw it at the extremes. because that was the extreme at the point the price reached, and is basically where the value is, where the extreme value is on that session. And at the low end of the range, you've got this, the lowest part of that range. You probably also, to be fair, you've got a lot of value down here. You know, these lows here, several bar lows here and there. So let's give this a little different color, but we've got an interim kind of value area here as well. Now, what I want to show you now is what happens next. Okay, this. Now, for those of you that have been following the thread, you'll know immediately what this is. This is what we call a swing pattern failure, or a swing failure pattern even. And what this basically constitutes, it's a very, very powerful signal, especially on a breakout, especially when you see this on a breakout. What we're seeing here is the price is taking out all the bar highs, right? So it's taking out the stops for everyone, all the buy stops for traders to get into the market, and then it's closing below this area. Now, as soon as it closes below this area, what's basically happened, okay? What's basically happened is that the buyers that got in up here looking for the parabolic move to the upside are now looking at that chart, seeing a huge pin bar and seeing that there's been, and that it hasn't moved up, and they're now worried. Okay, they're now on the back foot, so they're concerned. Now, the sellers that sold this area for the third touch, thinking it's a good resistance level, probably got stopped out on that spike. What happens when they see this pin bar? They get frustrated. They get frustrated that they've been stopped out and the market's come back down into the range. A lot of them get short again. They haven't got any discipline. They immediately get short again. Now, what I find interesting about this is look what happens next. Okay, the market comes off, and it comes off violently. Okay, it comes off very, very violently, because at that point everybody realizes that they're trapped. Now, you can't tell this from the chart, but one of the things that I wanted to illustrate about this particular example, which is why they're so interesting, is that this happened on news. Okay, and that basically means that alongside the orders from that area, from the breakout, there's a lot of buy orders coming in from the news. So anybody that wants to sell, any pro that wants to sell and wants to sell a large amount, has basically got a lot of liquidity from the buyers of the breakout, and the buyers of the news, and the buyers from traders that are puking or stopping out. Now, look what happens when it breaks out. Where do you think, if anyone got long here, the breakout traders that got long, some of them are going to have tight stops for sure, because that's what a lot of people do. They buy it there on the breakout, and they have a very tight stop. Well, they're going to get knocked out for sure. But where are some of the more cleverer little buyers going to have their stops? Well, again, what's regularly taught, put your stop on the other side of the range. Okay, buy it on the breakout, stop on the other side of the range. So where do you think this market's going? To the other side of the range. Take those guys out. You'll squeeze everybody out. Now, when it takes out that side of the range, look at the stitch up here. Look at this for a stitch up. It immediately takes out the longs, so the selling comes into the market, and it probably gets some more sellers in, because they think, false break, and here it comes, it's coming down, don't sell yet, right, here it goes, right below the other side of the range, this is a trade to short. And look what happens, we get the same bar we got on the upside, pretty much, not as long, we actually get it in this bar here, it takes out the low, closes above, immediately market retraces to this area here. So on both sides of that range, admittedly the top side has caused a more violent reaction, but on both sides there's little liquidity pools, and on both sides traders have been stitched up. And when traders get stitched up, that's when you really want to look for opportunities. Now, the swing failure pattern is something that we cover a lot in the thread. For a swing failure pattern, what we're going to look at, what we do look for, is a break. So for a bearish swing failure, we look for the market to take out the previous swing high. If there's multiple swing highs in the area, ideally you want to see it take them all out, but at least it has to take the last high out. Okay, and it will close below. Now, like I said, it doesn't really matter what time frame you find this on. It could be on the 4-hourly. I know some traders that trade this pattern on the 5-minute. The essential point is that that's what happens. Okay, and when it does happen, obviously there is traders on the back foot, and the market is usually going to go the other way. So you're going to get a break above and a close below. Same thing down here. You get a break below that low point and you get a close above in this little candle here. And that immediately tells you that the market is going to put in a retracement with pretty high probability. This is a very, very powerful pattern, and it's one that people should go away and they should study because it's very, very powerful indeed. And the important thing to remember about this is it's not really the shape of the candle that matters. It doesn't matter whether it's a pin bar. It doesn't really matter whether it's a doji. It doesn't even matter whether it's a bullish bar. What you're looking for is you're looking for those stops to have been hit. You're looking for traders to have been trapped, and then you're looking for the market to go the other way. So the break of the highs or lows is important, as is the close. Can it close back within the range? And that gives you a very high probability that the market is going to go the other way. Now, that's one of the setups that I look for basically on range plays. You will often get it as well on single swing points. I prefer them on range plays, but you will often get it as single swing highs, single swing lows. What I want to show you here is another example from, let's just pull this on the screen. Okay, this is crude oil. So what happens down here is you've got a beautiful swing failure right here. Okay, I'm cherry picking these examples for sure. They're not always going to work like this, but I'm just showing you, with clarity, because these are very nice examples of it, that you've got a swing low point. Okay, the market breaks it, closes below, takes that swing point out and closes above. What happens is, again, down there, again, thinking about what the rest of the market is thinking, people will have their stops below pins. That's a nice pin bar on the daily. The stops will be there. So the stops from that pin bar, if they're still holding it, expecting a bigger move, will be knocked out. But think about the trend beforehand. Look at this. We're in a downtrend. Lower lows, lower highs. What happens when we break that low? The downtrend's in full force. That's what the rest of the market's thinking. And on that candle, they've suddenly realized that their thinking is wrong. What happens when their thinking is wrong? They've got to make their thinking right by getting out. Anyone that's short down there needs to get out. Okay, and as they get out, then obviously you can see that buying comes into the market and we push up to new high. We push up to new highs. Okay, so again, it's a classic little stitch up area going on this particular chart, and you get a lot of these. I mean, we see them all the time. We saw some fantastic examples. I won't go over. I've gone over a lot of these in the free thread, in the free webinars as well. But just for some of those of you that are new, we had a nice little example of one here in cable. Again, this is a daily chart, but don't worry too much about the time frame. We've got one in cable here, and look at the lows. Okay, bar low, bar low. People are buying as it comes in. Triple bottom this could be. Let's buy it. Oh no, we've just got stopped out. And as soon as they're stopped out, there's also people selling the breakout of confirmed support. This one is what I look for is the market to take to try and basically catch as many people offside as it can, because when it catches people offside, that's when you get the most violent moves. Okay, now look at this in cable here. This is particularly interesting to me, and I'll tell you why. Support here, okay, and support here as well. So a really good confirmation of support. Then support here for the triple bottom. Now, as it comes back down to that area on this candle here, there's a lot of buying coming in. Look, it creates a kind of pin bar, albeit one with a bit of a big body. Maybe some of you guys who trade pins wouldn't actually like that candle, but that's kind of irrelevant. The rest of the market's buying it there, okay? And then look at this. This is what we call the stitch-up candle. This is the swing failure. Okay, note that before it can make a big rally, it's got to come down here and get the smart money in. It's a liquidity pool. People will be shorting this, thinking it's going to break out violently. There will also be stops underneath it. It's a massive support level, and it breaks. It fails to close down there, close above, and off we rally to the upside. Now, some of you guys are going to know from the free webinar, I think it was a couple of weeks ago now, I think it was a couple of weeks ago, I was very, very bearish cable. And reason I was very, very bearish cable is because part of my philosophy is that when markets return to areas multiple times, they want to take the order flow. Okay, they want to take the order flow out, and they want to fill that order flow, and you can often get a sharp move on that order flow when it's filled. And I was pretty bearish cable because I was looking at this thing. It was been there once, twice, 3, 4. It caught everyone off guard there, and it had a big rally. But it's come all the way back there again. It's sitting on this area, and it looks like it's about to break. And this time, I think it's going to go. And I really thought, and I was telling everyone in the webinar, I think cable is going to really collapse at this point. And we need to put our opinions aside. As traders, you need to put your opinions aside a lot of the time and have a look at what the market actually presents you with. Because once again, it's caused swing failure. That low, the last low of the range, gets broken, and we close above. And we suddenly get a 10-day rally, which I wouldn't like to confirm this 100% because it was only a quick bar count, but I only spotted one 10-day rally in the last 23 years in cable. Like I say, I might be slightly out on that, but I did a pretty good count, and I couldn't spot a 10 days in a row more than once in 23 years. Either way, even if it's been a couple of times and I'm slightly miscounted, it's not a common occurrence. You only have to go back and see, and it's obviously a very, very violent move. Part of that, I'm sure, is going to be because there are a lot of people that are caught off guard here. A lot of people are caught offside, and part of what, just going back to the New Zealand dollar trade, part of why I thought that was such a good example, and I shorted that market very, very quickly. This particular one is set up here. Part of why I really like this as a setup is because I was bullish. Okay, when it broke out of this area, I thought it was going to go higher, and I was saying to people, I was on Twitter saying, right, I think this is going to break out. Look for the retest, and we'll try and get long. And it came back down so sharply. And as soon as I saw that candle, I thought to myself, how many traders out there are not going to have the discipline that I've got to wait for a retest of that? How many traders are just going to have bought that on the news, got excited, bought it on the green candle, and they're now going to be on the back foot? So it's kind of, as soon as I'd seen that, I thought, well, I've just got to get short here. Because again, a lot of people are trapped, and when they're trapped, you're going to see the market move. So traps, like I say, are key. Really key patterns to watch for, and the biggest and best traps usually will come, although these swing failures will work at single swing points, the best ones usually occur at levels of multiple support or multiple resistance. Okay, remember, the more defined the level, the more people have noticed it. The more people that have noticed it, the more the order flow will build up, and the more there's likely to be a stitch up going on in the market. Now, just going back, just taking a side step for a minute, and just going back to this whole factor of liquidity and traders wanting liquidity and trying to get liquidity in their trading. What it also pays to think about is the fact that a lot of stuff in the market is forward prices. Okay, the market moves a lot of the time on expectation. You might have heard that saying before: buy the rumor, sell the fact. And that can work in reverse as well. Sell the rumor, buy the fact. Now, I want to give you an example of this in crude oil from last week, because in crude oil, if we have a look, what happened here, there was a swing failure in crude oil here, right here. So what happened is we had a bit of a trading range going on. We had these bar lows here and that bar low there. The last swing point was this one here. And the market broke it from this candle, and it closed above. So then where do we think the market's going? It's going to start to move to the upside. We know that it's a very high probability pattern. Now, if we have a look on the hourly, after that swing failure occurred, okay, which was here on this day, what happened here, and this is quite interesting, what happened here is that that night, so the market kind of moved up. The next day it retraced and it started to move up again, and we're then wondering whether it can take out yesterday's highs, which are coming in around here. Now, what happened is crude oil has some particular news, which is the inventories. Okay, how much crude is being stored in inventories in the US, and they have these numbers that come out. Now what happened is overnight on Tuesday night here, as we just rallied off the lows with the swing failure on the daily, okay, so we get swing failure on the daily, market pulls back, market begins to move up again off the lows. Now the API numbers for crude oil come out overnight and they show a big build. Okay, so it's a big build in inventories, which means there's a lot of supply on the market, and that's going to create price pressure. So that this is the market trailing off overnight, reacting to news. Okay, the next day they know the API numbers show a big build, so they're probably expecting the DOE numbers, which come out at 3:30, to show a big build as well. Now look what happens here. Again, I know some of you guys don't trade news or don't care about it, but just to clarify exactly what happens here is that the market moves down. Okay, and as the market moves down, it gets to the last little swing point, not the big swing point, it gets to at least the last little swing point, and it breaks it. Okay, just nips it there, and then it starts to go ballistic. Now what happens here is the DOE numbers come out at 3:30. This is the candle. The DOE numbers come out and they show a big build, right? So the first thing I got in my, so again, you'd expect the market to go down from an economic standpoint. They already, they basically, those numbers confirmed what the API confirmed overnight. So the first couple of questions I was immediately getting in my trading room is, well, hang on a minute, why is crude rallying here? That's a really bearish number. And what you got to remember is that the news is now out there. The fact is now out there. They knew it was likely to be bad because the API was bad. So when the DOE comes out bad as well, traders are probably going to take profits, or even some traders then looking to get long, because the news is out there now. Okay, and remember that traders that want to buy crude oil, maybe they've got a fundamental reason that they want to buy it longer term, they're not interested in this particular number, they think it's going to go up in future, or they want to buy it for a technical reason. Whatever reason they want to buy it, they need a lot of sellers. How are they going to get sellers on a really bearish DOE number with price breaking swing lows? Okay, so again, it's another little stitch up that's going on in the markets. Now, let's leave this aside for a minute in terms of swing failures, and because that's a nice little strategy in and of itself. But what I also want to talk about is what's basically going on when there's a genuine breakout. Because one of the ways, I mean, a lot of traders focus on breakouts and of areas. And what the question I want to get you guys to be able to answer to yourself, and if you can answer this question, you can make money from it. What you want to ask yourself is, if there is a breakout, is it a false breakout or is it a genuine breakout? Now, we've already seen the signal for a false breakout. If we get that signal, swing failure, then we've got a high probability that it's going to be a false breakout. It's not going to work every time, but it's very, very high probability. You have to go back over the chart and look at this. A lot of people are making money off this pattern. But let's move on from that and look what happens if it's a genuine breakout. That's something that we're going to want to trade if it's a genuine break. Okay. Now, again, let's look at what is happening on a genuine breakout. Here is where we get what I would call a genuine breakout. Okay, and I'm going to just try and annotate on this chart. Let's see if my voice breaks up when I do it. Be a bit memory intensive, this. Okay, so we get a genuine breakout here, and it's characterized by a big candle, huge amount of selling pressure. Okay, market breaks down. That's the first tip off that it's a genuine breakout. Big candle that closes firmly through and away from the area. It's one of the first little signs we can look for if it's going to be a genuine breakout. But let's, rather than looking at signs for a second, let's look at what people are doing. Let's look at what traders are doing. So, let's look at the guys that shorted it on the breakout of this area, just the stop sells, the people that straddled, the people that lost money doing that up here. Well, they got right this time. They got right. That's the nature of the breakout. Sometimes you're wrong, sometimes you're right. I don't think it makes for a particularly good edge, because it does seem pretty 50-50 to me. But sometimes you're going to get it right, and these guys got it right at that particular time. It steamed in, the market tanked, they're in the money. Okay, but what happens when it comes back to the breakout area? In this scenario, which it often does, what's actually happening? Well, first off, you've got these guys that shorted the breakout. What are they thinking? Well, they're thinking, uh-oh, price is coming back here. Price is actually coming back. They don't like this. Okay? So they're a little bit concerned as to why price might be coming back at that point in time. That's the first thing that we're going to draw your attention to. The second thing to draw your attention to here is that a lot of professionals pyramid. And we know that the rhythm of the market is that often levels get broken, levels get retested. So if anyone did short this, if a professional did short this, he perhaps saw the book that it was going to break down and he shorted it there, he may well pyramid at this point. So there's more selling pressure coming in at this point up here. Now, what about people that didn't trade the breakout? On the initial move, they saw the breakout, but they didn't trade it. Well, when the market comes back to that area, they're thinking, well, I've got my second chance to get in. I can short that now. It's back to the area. I missed it the first time, but I'm going to damn well get it the second time. And so they crack it as well. And this is why these markets often basically make a flip between support and resistance. So if we move over and have a look what actually happens, you can see right as it comes back to that area, price flips. Okay, so the sellers, the people that miss the breakout, when it comes back, they're desperate to get in. They'll sell at the original level, thinking it's going to make its next leg down. The pros will be pyramiding. There will be people like us that know the market rhythm and know that's what it does, that will be putting offers there. And hence you get this rounded retest. You get the market pull back, you get the market drop off to the downside. Okay, this is what is happening when these markets break out. That is why they're basically making this pattern. And this is the next thing that I look for. Like I say, if it's a genuine breakout, what you're going to look for is you're going to look for a solid candle to take the level out. And I usually like to see it keep going. I like to see supply keep coming in. I don't want to see it come straight back. All right, I want to see it keep going. And then I want to see it come back with some space. And if there's space and time has gone by, which creates the space, then I'm going to be willing to trade it. Now, why is the whole time concept important? The whole time concept is important partly because the more time that's taken for the market to break out and stay broken out, the more chance the pattern's going to be showing on a higher time frame. Okay, so think about that for a second. The longer it stays, breaks out on an hourly, the longer it stays out through this area, it's probably going to be showing up on a 4-hourly now. Hell, it might even be showing up on a daily. And the bigger money often trades the higher time frames. Right, so the longer it, because I'm a fairly short-term time frame trader, I'm actually happy for it to break out and stay broken out. I'm not worried about missing the move, because I know that it's probably appearing as a breakout on a higher time frame. Therefore, more people have seen it. If more people have seen it, more people are going to be acting and sitting on the offer when it comes back there. That's why I like time to have gone by. I never ever worry about missing the move, because most of the time these markets will come back to the breakout area, and when they do, that's where your opportunity is going to be. So this is one of the things that I look for. Now, I think Roe, I mean, the question, why does it come back? Well, I think a lot of the time it comes back because a lot of traders in the market are short term, and a lot of traders take profits. A lot of traders on that sharp breakout are going to book some profits there, and often the market will come back on that buying on the initial move and come back to this area. But the other reason why is because when you've started drawing in levels and mapping your market, you'll often find that the market oscillates between areas. Why does the market come back here? Well, let's just look left. Look left into this area here. I know it's not picture perfect, but you've got bar highs. Traders that are in short into bar highs are usually going to book some profits down here. And guess what? People are going to see those bar highs and try and get long. After all, if we zoom out, we're in an uptrend. So it's really what's happening is that the market is kind of, what it does is it just oscillates between the areas of value. You know, so the market comes down into these bar highs, moves up into bar lows, comes back down again. And it's happening all over the place. So I try and map out the levels, and I try and only trade at the best levels. But I try and map out all the key areas so I know what price is doing, where it's likely to bounce. If I was short on that breakout, there's no way I'd be gambling with this area. Look how many bar highs there are. There's a huge amount right in this area here. So down there, then I'm going to want to book some profits as a professional. If I book profits, I'm buying. If other people are joining me on the bid, then up it goes to this area. Once it gets up there again, I'm happy to sell it. Why? Because it was prior bar lows, and you get this whole flip. You get this whole flip in structure between support and resistance. So something else I would talk about here is when you get an area where the market basically, let's have a look. In fact, there's probably, let's zoom out here. Well, basically, when the market does break out of an area like this, zoom in again. Whoops. That's my screen. Right, okay. Okay, so when the market has these bar highs, and again, it's probably not the best example, actually. Delete some of these levels. Probably not the best example out there because it's not a very, very big level. But when you get these bar highs here, okay, you're going to get traders, as we said before, selling at prior bar highs. Okay, so as it comes into this area, traders are going to try and sell it there. Now, when it goes ballistic right through that area, what is immediately happening? Traders that shorted it are worried. In fact, they're very worried because look at the size of that green candle. But what do a lot of traders do? Well, a lot of traders don't like stopping out. All right, now if you think that, you know, anyone would be crazy enough to hold that up there, then you need to become a mentor, because you'll find that a lot of people do. They don't get out of trades. They just don't like getting out. They don't like taking a loss. They keep thinking it will come back, like it's so overdone. Now, what happens is, though, is that when it comes back to this area, what are they probably thinking? I just want to get out. I just want to stop the pain and get out. I've been so far offside, I just want to close this position. And obviously, if they close out at this area, then they're going to be waiting to buy it again. It's close to break even, maybe hopefully at break even, but as close to it as they can get, they're going to be buying. That's one of the reasons why levels often flip. Okay, so selling comes in here, the sellers hold, they panic. As it comes back, they're literally praying with themselves to get out of break even, and the selling here then turns to buying as they puke it for break even. Obviously, as they puke it for break even, we know there's plenty of pros that know the market rhythm that sit on the bid. So again, there's more buy orders stacking up when price comes back into these areas. Let's look at an example here from USD Canadian dollar. It is an old example, and again, it's a cherry-picked example, which is where I've chosen a one that's worked fantastically well to wow you all. But it's a good example nonetheless. Okay, let's have a look at this. Right. What happens here? Okay, so forget about this little price pivot flip for the moment. Resistance. 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 Now, as it comes back there for the second, third, fourth, fifth time, what are loads of traders thinking? Well, loads of traders are thinking that basically it's a good sell. Why are they thinking that? I mean, you might be looking at it thinking, I'd never sell that there. It's making higher lows. It's hitting this area repeatedly. It doesn't matter what you think. You're probably ahead of the game. A lot of traders are thinking that's a good level to short it. It's confirmed resistance. So when it breaks out like this, again, let's go back. And I know we're going over this multiple times. Let's look what happens. It breaks out of the area. Okay, the sellers are in a whole world of pain. They're desperate to get out for break even. Some of them will be, you'll think, well, hang on a minute, it's closed out of there for days. You'll be surprised. Traders will hold. They will hold it, hoping it will come back there. And if it does come back there, they're going to scratch it. So their selling will turn to buying. But let's forget about them for a second. What about the people that missed the breakout? They missed the breakout and they're thinking, whoa, look at that. 5 days up in a row, that's massive. If that ever comes back there, I'm going to buy it. Forget about them for a second. What about the people like you guys and like me that know that this is what markets do? Markets break resistance, that resistance turns to support. We're all waiting on the bid at this level. Look what happens. It comes back, it churns, and off we go. A really, really violent move to the upside. Now, let's have a look at this. Triple top. Let's forget for a second that this is actually a swing failure of that bar high, and the market does move down as you'd anticipate. But let's have a look at that triple top. What's happening here, guys? Same as in the example down below. In fact, it's exactly the same. Higher lows. Market's moving up just like it was down here. There's no difference. There's no difference. Market is making higher lows into a solid area. This is the first time you can look at the chart and go, yep, I knew that was going to break out. Look at the higher lows. But look at it over here. Same thing. Higher lows into an area. So it should break out, right? No. Let's go in and zoom in. What's that? That's our swing failure right there. All the highs get done. All the highs get taken. The bar closes below. Look at the violence of the next bar. Everyone that's bought the breakout is thinking, oh shit, I'm on the wrong side of the market. Sellers that got in there, certainly on the short-term time frame, probably stopped out. Sure, you'll have a few people that maybe sold it there for the quadruple top and kind of just got stubborn, didn't want to get out and held it. Fine, but a lot of people on a short-term time frame would have been knocked out of there because it spiked pretty hard. The level was at 15, so we spiked up to 63s. So definitely some short-termers would have been knocked out. Some pros would have got a nice little opportunity to accumulate a short position in USD CAD up there. Look what happens though. That's right at the top of the market, and it's a swing failure pattern again. But the interesting thing to know about this is it's exactly the same as this. You know, the only difference is the setup. Up here, we got a swing failure. We knew there's a high probability it's going to move down. Down here, we didn't get a swing failure. It took the highs out, it closed above them, it kept going. Therefore, the difference is we know to sit on the bid on this one. On that one, we know we want to try and be getting short. So it's just a question of looking at these patterns, trying to see who is in trouble, who is trapped. And when people are trapped, you're going to get those aggressive moves. Okay, and the market is kind of, that's the thing. I have often seen these kind of candles and like that, and you see that, and what you're saying, Hugh, makes perfect sense. And again, think about how many people are thinking like you. Very bullish looking candle. Yeah, that looks good. If I'm long there, I might hold that. Yeah, I think I'll hold that. It looks very bullish. That's probably going to go tomorrow. And what happens when it goes red? You've got to sell. You might have a stop below that bar low. You might have a stop below this swing low, but the pressure's on you now. You're on the back foot. And I found that with swing failures, it doesn't really matter what the candle looks like. They are so effective, it's unbelievable. And it doesn't matter. I mean, that's not a candlestick pattern by any means. It's not a bear. Like this one was a bearish pin bar. This is nothing. This is not a bearish outside. This is not a bearish pin bar. It's not even a doji. It's just as bullish as you can get, pretty much. It could have been a bit more bullish if we closed on the high, but it's a bullish looking candle, and it's the top of the market. I actually know someone that sold up there and on that actual pattern and made a lot of money from that. But it's that pattern and that idea that people are trapped in. When people are trapped, there's always the best moves to make in these markets. So it's something that I look for. It clearly gives me a bias. When I see that on whatever time frame, if I see it on a daily time frame, I got a bias for the next session. I don't really trade daily charts anymore. I trade hourly charts, but I always take a bias from daily charts. Now, what I want to do today, and I know this probably sounds to some of you guys like I'm giving you a bit of a teaser and not revealing everything. That's not honestly my intention. But what I want to do is I want to kind of build this slowly so you guys get very familiar with the patterns So I don't want to exactly tell you how I trade these. Most of you will pick it up from the thread anyway, because it has been mentioned in there. But for now, what you want to do is go spot them. You want to go spot these and see how they play out, because they're very, very effective. Sometimes you will get them and they will be minor and they will work very nicely. Look at this example in, zoom in. Look at this example in the Aussie dollar. Okay, first off, bar high, multiple bar highs here. Obviously we get swing failure there, which creates a bearish outside bar. But there's also a level up here, right? Right around here. Bar lows, flip to bar highs, bar lows, bit messy. But it's a swing point. That's the last swing point. Look what happens on this green candle. That high is 103.79. This high is 103.85. Takes it out by 6 pips. The close is 76. So it's swing failure. As soon as we get swing failure, what happens? The market comes back down. Now, who would look at that and think that's a sell right there? Because I wouldn't have done back in the day. But nonetheless, short term, it's taken out highs and failed, and therefore people are on the back foot. Again, on what you see happening here is once that level gets broken, the market retests this little area. So you see these things happening, and like I say, not all examples of it are going to work. What I try to look for is really clear swing points. So swing points where the market has dramatically fallen away, come back to them and failed at them. Or even better is areas of solid support and resistance, where support and resistance is really stacked up and then the market fails there. Now, not every example is going to work. Like I say, there's one here, in fact, that doesn't work. That one there, that swing failure, takes the highs, closes below, doesn't work. So nothing's going to offer a holy grail, but it's a very, very powerful pattern to look out for. And there's a lot of people that are from the thread and emails I'm getting are making money off this. You definitely want to watch it and take note of it. Now, did I learn the SFP in prop? No. Funnily enough, I learned it by analysing somebody else's trades. And this is why I say to one of the first posts in my thread was how you guys should be keeping a track record. Because if you keep a track record, not only do you know your progress, but when you review your past trades, you can really learn something very, very powerful, which is basically how you get better in this game. And I spotted a pattern now. This swing failure pattern has made me a lot of profit, a lot of money that I've been making off this swing failure pattern. It helps you to call the market moves with a huge degree of accuracy, and the only way I spotted that is going through one of my students' trades. Now, this was in USD Canadian. I kid you not. This was in USD Canadian. I had a guy that was losing money constantly in USD Canadian. And what he was doing is basically, he was identifying a swing point like this. And as soon as the market took it out, like there, as soon as that market took it out, he said to himself, okay, we've made a new high. Refer back to what traders are taught all the time. You make a new high, we're in a bull market, higher highs, bull market. So as soon as it made a new high, he would then wait for a little bit of a retracement and he would sit on the bid. And he would get immediately stopped out. And he'd say to me, I don't understand what I'm doing wrong, Tom. You know, I'm going with the trend. It's made a new high, and I'm getting stopped out of this. And I said to him, well, I don't know what you're doing wrong. Let's have a look. Have you saved your charts? Show me your entries and exits, and let's have a look what's going on. And he annotated all his charts. He said, I'm getting in here. This is why I got in. He was showing me all his charts. And as I was looking back through them, I noticed there was one thing which linked all his trades. The high point, yeah, you guessed it, the high point that he then thought was bullish, when it triggered, the market closed below it on the time frame he traded, and it linked all of his trades. Every time that happened and he'd gone long, the market went down. So I suddenly thought, hang on a minute, he's getting long there, and every time there's that swing failure, breaks a prior high, closes below, the market goes the other way. And I thought, well, that just must be, coincidence on his 6 or 7 trades. And I started looking back, and I was absolutely gobsmacked. I mean, absolutely gobsmacked how often you see this pattern occur. And what was so interesting about that is he had no idea. As soon as he showed me his charts, I'm not trying to big myself up, but as soon as he showed me those charts, I spotted that in about 5 minutes, that was what linked his losers. He had absolutely no idea. Why? Because he didn't even keep notes of his trades. He wouldn't, if I hadn't asked him to do it and send them to me for me to look at, he would never have spotted that. And actually, I would never have spotted it as well. So I thank him for doing it. But it's quite interesting. It's quite interesting how sometimes you can not only work out how to do something better, but spot a whole market pattern that will revolutionize your trading just by looking at what you're doing. So a record is really, really vital to this game, I think. So the final thing that I wanted to kind of talk about today, in terms of going over trades and going over strategy, one of the things I wanted to look at today was basically what professional traders try to do, and what I try to do in my trading is I try to enter at the source of the move. What I try to do is I try to enter ASAP as soon as I know that there's a good area that the market might bounce off, or that traders might be trapped. Okay, so it's all about entering at the source. Now, when I started trading pin bars. And I still think to this day that you can make money trading pin bars. I'd never say that pin bars are not a good source of making money. That's absolutely fine. There's one beautiful one here, for example. Incidentally, have a look what that pin bar is. Pure coincidence. It's a swing failure. Where would we get in on the close of that bar? Where would the pin bar traders get in on the break of the high? Save yourself a little bit of money on that by getting a slightly better price. But nonetheless, let's talk about that pin bar for a second. To me, and this is maybe not the best example because again it's kind of a double whammy. It's a swing failure and a pin bar, so it makes it double strong. But if you've got a good level and you get a pin bar, in fact, let me show you something in Euro Yen. This was a trade I took as well on the hourly chart on Euro Yen, and this will illustrate exactly what I mean. Nice detail. If I can find it, zoom out. Okay, here it is. Okay, let's have a look at this level here. And again, be thinking back to what we said about the USD Canadian. Higher lows into an area. Horizontal resistance. What's happening up here? Orders stacking up thick and fast. People shorting it aggressively. Stops above the highs. Where are they going to put their highs? Where are they going to put their buy stops to get out? Probably above this last swing high here. Maybe give it a bit more room. Maybe stick it there. They're trying to short this. What else is happening? Buyers seeing that level. Breakout trade. Alarm bells ringing. Let's get in if it breaks out. Okay, so the orders are stacking up. It's becoming a liquidity area. Now, we don't know whether it's going to be a false break and collapse. We don't know whether it's going to break this 106.59 level and be a false break and collapse, or whether it is going to be a genuine breakout. We're going to let the market show us. If it's going to be false, it's going to take out the extreme high, close below. Okay? Now, if you look at what this does, it doesn't actually create a swing failure. It takes this area out, it closes only a pip above, but it does close. This high was 105.73s. This close is 74s, and it's actually a bullish engulfing. So we know this is not a swing failure. We know this is a genuine break. Look what happens. Off it goes, violently. Now, in terms of entering at the source, I want to get long with other people that are going to be bidding on this, people that are going to be seeing it. Remember, think back to who it was. Shorts. Shit, they're offside. They're going to scratch. They're going to buy. People that missed the breakout. Damn, look at that breakout. I missed it. All right, I'm going to buy it when it returns. The pros, they know the rhythm of the market. Here it comes. This is good. It's coming back into the area. Let's bid for it. People are bidding here. Okay, now I want to join the source. I'm expecting this to be the source of the movement. I'm expecting the bids to come in at 105.59 area. Okay, now let me zoom in here and show you what actually happens. Here it comes for the retest, and there's the pin bar. Creates a pin bar. Now, to me, as a trader nowadays, I will be long at 105.59s. The pin bar traders will be long at 105. The high is 82, so they'll be paying 83 plus spread. They'll be paying 86s. I.e., I've got nearly 30 pip better entry than them at the source of the move. They're paying up here. They're paying up. Now, to me, like I say, a lot of people go to talk about pins. I mean, this pin works for sure, but you get a much better R if you get it at the source rather than if you chase the price all the way up there. Now, what I look at here is the fact that, and I've started saying this recently, and I'm sure it does cause a bit of controversy, but what I was saying is that in a way I think of price as a kind of lagging indicator, because we know with a high degree of accuracy, once you started looking at market rhythm and studying it, you know that this area is going to attract some bids, the high degree of probability, right? But once it's created the pin bar, how do you know it's going to go further? Because it's lagging. All this pin bar shows you is that bids came in here and it's now closed up there. If you want to buy that pin bar, you're buying it 30 ticks above where all the bids came in. Now, okay, fine. A lot of the time it carries on to the upside. But like I say, if you can get in at the source, you've got a decent buffer if this pin bar fails and it comes straight back on you. You're already on side. You've got a bit of maneuverability here. Also, since we're playing these a lot of the time to the FTA, which is these bar lows, and also if we zoom out, whoops, if we zoom out, that bar high there, correlated to these bar lows, we've got a much better R on the trade if we get in here than if we buy at the top of that pin. So it's the point of, in a way, buying it here is the point of lowest risk. Why is it the point of lowest risk? Because it's the point at which you're closest to potentially knowing where you're wrong on the trade. So buying it at the source is really essential to me. I want to try and get in at the exact area. Okay, and like I say, if you think about pure market dynamics, that again, the strategy behind this is that if you're going to buy a market, what do you need? If you want to have a profitable trade and you're buying a market, you need other buyers to follow you. That's how that's the only way the market's going up. If you get in and other buyers follow you. So if I buy down at this level, I know I'm buying with other buyers. If I get in up there, yes, it's created a pin bar. Yes, a lot of people are going to see that and think pin bar, bullish price, trade the pin bar. But the source of the frantic buying is going to be at that level. And so that's what I now try and do nowadays. And it's not to say that it's a way more, better way of doing things. It's a different way of doing things. But it gives you, as some of you guys are saying in the chat, it basically gives you the point of lowest risk. Now, when I'm looking for, to answer your question, Nick, what I'm looking for is basically the point I'm placing my order after the breakout is I'm waiting for it to be a genuine break. So I want to see a close above that area, and I want to see it go. So if you think a nice little way of wondering when you should put the order in is look at the chart, and at the point that you think, geez, that's not coming back, I've missed the breakout, stick your order in. Now, it sounds funny, but that's basically what I'm thinking. And you'll be on my kind of wavelength if you're thinking like that. The point at which you think, wow, I've missed that, that's going parabolic, that's when you want to put your order in. Because to me, really what I want is space. I want some space. So I can't really put the order in on the first bar in case it comes straight back on the second. Then it will be churn. There won't be a lot of space here. Once it's gone up here, then I know that I got a bit more space. But I try and wait for space to develop. I probably wouldn't have put my order in on this until maybe around about this candle here. By that time, if it starts to fall, I'm developing space here. So I don't get in on the initial breakout at all. I wait for confirmation, okay, and then I get involved. And that's how I trade these breakouts. Now, to move a little bit a step forward here, is a lot of people talk about what they call the butt kiss, a bit of a disgusting term, but a lot of people talk about this butt kiss, which is an immediate retest. When we break out, we pull straight back, and then we break, and then we move to the upside. Now, a lot of people say, do you trade that? Would you trade that? Now, I don't. I mean, there are circumstances, and I can't get into them now, but there are circumstances where I will. They're quite few and far between. But I prefer a rounded retest. All right, and one of the reasons I quite like a rounded retest, not only because I've looked at both of them and I found it seems to work better and work more accurately. The drawdown's often less. Look at the drawdown on the rounded retest versus the immediate here. Fair enough, the immediate may not have stopped you out, but it's still a bit more emotional pain. Right, I've often found that with immediates, that they can be quite messy. But think about this for a second in terms of our buyers and sellers that are interacting. With the sellers that came in here, that shorted it, and there will be a lot of them, they'll short it here. We said that one of the reasons, not the only reason, but one of the reasons that makes the immediate retest, the rounded retest quite nice, is because those orders, those buy orders are stacking up from people that want to scratch. They sold it there, went offside, they got very upset, it takes a long time to come back, and the longer it takes, the more pain they're in, the more they just want to get out of this trade and move on to the next one. So those orders are stacking up, right? Now, what happens on an immediate retest? Probably a lot of those guys, a lot of those shorts, probably won't scratch. This is just my theory, but they probably won't scratch. Why not? Because it hasn't caused them that much pain at the moment. It's time and it's energy that causes them pain. On that, they may be then relying on hope. Oh, it's, it's not convincing. Maybe that's going to come back. They're less likely to scratch, in my opinion, on a break and a quick return to the level, because they immediately think there was a false break. It's coming straight back. Remember that bar would have been red at one point. But they're much more likely to scratch here because they've been in pain for longer and they've been offside further. So that's one of the reasons, but the main reason is just from having traded loads of these, I found that that I much prefer, and it's much more reliable to trade a retest where you've got space. And I call it rounded. Really what I'm looking for the market to do is, it's not so much make a rounded motion like this, although it often does, but it's more just to create space. I want a bit of a vacuum in here where no price is traded. The more space I've got, the more I like the trade. So to me, like I say, nowadays, a lot of it is about entering as close to the source as I can get. Okay, now we'll put it over to a Q&A session now. Has anyone got any questions on the kind of stuff we've looked at today? And I'd prefer, I don't mind answering anything, but I prefer not to talk too much strategy at the moment, because a lot of it's simplistic. It's not always a question of, where exactly would you put your stop. There's not an exact place every time that I don't do anything mechanically. It's completely discretionary. So when it's a question of where would I put my stop, for example, I'll put my stop at a place that I think the market won't squeeze to. It's never going to be a fixed value. It's never going to be beneath it's not always going to be below a swing low or above a swing high. It's going to be a place where I think the market shouldn't reach easily. And again, this is something we'll get into in later webinars, because I think that stop placement is very, very important. Stop placement increases your chance of catching a profitable trade without getting knocked out. So is trade management. I'm sure everybody's going to be saying, well, where do you take profits? You can't really systematize it. Sometimes I'm going to run trades, sometimes I'm not. Yes, Rob, just have a quick look at that. In fact, this is a good question, Rob, and I'll get into that question in a second, Alan. Just look at Rob's question for a second. I shorted gold on Thursday at 1703.3. Okay, 1703.3 was my exact short. Now, I'm going to draw a level there. The exact price I shorted at, 1703.3. All right. So what was going on here? Resistance, cluster of support, 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 support. Breakout, violent breakout. That's definitely genuine. There's nothing false about that. That's a definite, genuine breakout. Sometimes the market comes back quickly, sometimes it doesn't. When it comes back to that area, I'm going to sit on the offer there. Now let me flick this down to a 5-minute chart. Okay, it's going to flick about for a second here while it loads up all the data. Okay, look at my entry on a 5-minute chart. After that move up, look at the precision of that. Because we know it's a strong level. I've literally virtually sold the high of that entire move. It's, you know, it happens. I don't always do it, but it happens. Now, this is where, on this particular move, actually, this is why I don't like talking about where do you take profits, where do you take stops, because a lot of people try and systematize things too much. I know on this particular trade, I know so many traders that lost money on this. I made 80 ticks, and I know a lot of traders that got picture perfect entry, same as me, and lost money. Why? Because the FTA was down here. Right, FTA was these bar highs, that bar high there. As you can see, market got nowhere near it. Market got absolutely nowhere near it. So why did I get out? Why did I get out of that trade? And I did get out of it. I did tweet it in case anyone's thinking if you got out of that. But I did get out of it. What I was thinking is you've got to think on the fly. And what I'm thinking is look at the state of this market. It's gone absolutely mental to the upside. Okay, there's a huge amount of buying coming in at this point. And it's coming in on fundamentals as well, which is interesting. All right, it's coming in on fundamentals. So the Fed not expected to look to even start raising rates till 2014. All right, it's very, very dovish. Okay, and the dollar got absolutely smashed. It got absolutely battered. And obviously, as the dollar got battered, gold went vertical. Now I'm sitting at that thinking, well, look, it's going to get offered there because it's a good level, but there's no way I'm going to sit there and expect that whole move to get undone because it's a very, very violent move. And part of what was helping me make this decision to get out at 95, so I got out here. Basically there. So call that little pullback. Part of that decision was when I looked over on the charts, it was a very, this was a very minor little FTA. There's a few bar highs kind of around here, there, a few bar lows there, right into that little area at 95s. But part of that reasoning was what the rest of the market are probably going to be thinking here. Okay, I like acceleration, but that's a lot of acceleration. And what's the rest of the market going to be thinking? A lot of people are going to be trying to catch that move. A lot of people are going to be trying to sit on the bid. So any excuse, any pullback, they're going to be looking to get long. And acceleration is good, but this was really, really sharp acceleration. And you had to be quick there. You had to be really, really quick. But this is, like I say, this is why I don't like sort of saying, right, you always take profits here, you always put your stop there, because it does depend somewhat on the markets, on the particular markets. This was another trade that I called live, admittedly a long time ago now. This was on dollar yen, and two things to draw your attention to here. And like I said, this is not to big me up. I'm just trying to show you the patterns here. One, what's going on down here? Support, support, support. Well, let's take it a step further. I caught that, Stefan. I'm about to show you. Support, support, double bottom, right? What's that? Swing failure. Whoops, the shorts have just been stopped out. You know, the people that the shorts that basically got in expecting to go with the downtrend are now on the back foot. The longs that bought for the multiple touches, well, they've just been spiked out. Market moves up. Have a look at this. Now, where's the level? Where's the last swing low? Here. That's the right extreme end of the range. It's got a few more bar lows here. Okay, a few bar lows there. But the extreme end of the range that we look for is there. What's this? Swing failure. I got long off that candle. And yes, I did catch that entire intervention move. Okay, now the reason I caught that intervention move is because the way I trade these swing failures, and I'll just give you, I mean, I'm not going to go way into this now, but the way I trade the swing failures is I enter on the close of the bar. So that answers one of the questions I saw. I entered on the close of the bar, and I put a stop on close below the low. The market has to close below the low of the bar I enter on. Why does it have to close below the low? Because I've noticed multiple times that it will break the low, continue to stitch people up, and if it doesn't close below the low, then the pattern's still valid. And that enabled me to catch that intervention move. Now, I also, believe it or not, sold this. I know everybody's probably thinking, if you made these kind of trades, I swear to God I sold this, and I'll show you exactly what I did here at the top of that intervention. This was another intervention move, and I'll tell you exactly what I did here. Again, I've gone over this in the thread a while back. Let me just show you again. Okay, let's have a look. I have to zoom out a little bit here. Zoom right out. Okay, 80. Support, 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 support. How much support do you want there? It's a brick wall. It's an absolute brick wall. Okay, let's move forward. Now, the market is moving down. The market has a violent move to the upside. Loads of people trying to get long here. Loads of people also trying to sell, thinking it's a little bit overdone. One of the things, and I'll get into this in a future webinar, is I always like to sell what was last support, buy what was last resistance. Okay, now if you look at this on the way up, where are the levels on the way up approximately? Starting from the bottom and working our way up, what have we got? We've got a bit of a level here. Well, roughly. Let's take it one step further. Resistance there, resistance there, resistance there. Support. Bit of a PPZ, not a bad one. Look at this one here. Resistance, resistance, resistance. Flip to support. It's another good PPZ. What about that one there? Nice resistance. About this one up here. Nice resistance. PPZ is where price flips, support, price pivot zone, where price pivots from support to resistance. So we've got a lot of levels on the way up. All right, which is the only one that creates a violent reaction? Well, it's the one I sold at. And why? Level. If you look at this, that there is the only level on that whole chart of all the ones I've just drawn that was support last. Look at this one at 79.58, resistance last. 79.28, resistance last. 78.68, resistance last. 78.02's resistance last. It went completely vertical until it ran into the last major brick wall that was the inverse last, that was support last. And when it found it, it had a violent reaction. Okay, now on that particular trade, let's just move back here. This is where it comes back down to it not always being easy. You've got to read the market, you've got to adapt to situations. Why do I get out of gold so quick? And why do I hold the dollar yen? I mean, look at it. It looks like gold. It looks the same thing. An absolutely parabolic move, accelerating. So what's the logic here? Why do I get out? Why do I hold this dollar yen, but I get out of the gold? I'll tell you why. Because it's market experience. What do we know about intervention? It's intervention here. What do we know about it? It fails. After intervention, the market always comes back down. Look at it here. 1. Intervention, bang, straight back to new lows. Intervention, massive pullback. Intervention here. That's the top of the market. Big pullback to new lows. Okay, intervention doesn't work. Now I'm pleased that Trader 8080 said that, because not all news, not all market movements are built the same. A lot of people say, oh, I don't trade news. I'm just interested in the charts. I'm not interested in any news. All right, and what you've got to think about with this is that's a bit, it's not the best attitude to have, because markets, if you have an awareness of what's going on, it can help you stay out of moves or capture potential moves. Okay, the Swiss intervention. If you look back on a chart at all the Swiss interventions from the SMB, they've always failed. Right? They've just been single interventions like the dollar yen, and they've always failed. Why? Because the market is stronger than a central bank, and the market manages to make its way from the forced selling and the economic strong fundamentals that kept it in the downtrend in the first place, pushes it back to new lows. So why did it stay up this time? Because they pegged it. It's very, very different. They didn't just intervene for a day and that was it. They've actually committed to a peg in Euro Swiss. What about this one here in dollar yen? We've just said that all the dollar yens have quickly come back. What about this one? This was intervention. Why was that different? That went vertical because that was coordinated central bank intervention. Now, how on earth would you know that unless you look at the news? You wouldn't. So when I say that I look at news, I don't mean that I'm staring at, oh my God, look, retail sales are 3% down, let's sell it. I'm not interested in that, but I like to know roughly what's going on. You would have had the opportunity of a lifetime to make money in that Euro Swiss if you had a news ticker. Forget the charts. If you had a news ticker, you'd have had the absolute opportunity of a lifetime. You'd probably never get an opportunity like that from a chart because this flashed across the wires that they were going to peg it at 120. Flashed across the wires, I believe price was around 113. All right, it had 700 pip move upwards after that. So if you can react fast and you can see things, you can make money. But again, it's not black and white. People might then say, oh, okay, well, what news do we trade? What news do we not trade? Nothing's really black and white. Because I'm a discretionary trader, I have to make decisions based on what I see in front of me at the time, and also what I know of the markets. Like I said, that's why I held dollar yen short but not gold. On a chart it looks the same, a massive accelerating move into a good level. Why do we get out of gold and not dollar yen? Because we know the circumstances are a little bit different in the two markets. So what I'm going to try and obviously reveal over time is all these things, how they form our strategy, what we look for. So today we've gone over the kind of core, which is why these, what's going on a little bit behind the scenes, and how we trade a breakout. Because you'll see that markets range the majority of the time. They spend the most of their time ranging. The MD at my prop firm once gave the famous quote that if you can make money in a sideways market, you're sorted. Because every fool makes money in a trending market. So if you make money sideways, then you're absolutely laughing. What we've looked at today gives us the ability to make money in a sideways market. If it false breaks the highs or lows of the range, we've got an SFP, we go counter. If it's a genuine breakout, we've got a trend continuation pattern. We look for our pullback. So actually today what we've learned is what's going on, but we've learned two valuable lessons in order to trade that sideways channel, that breakout. And we've also had a little bit of a look at resistance and support and what you should be doing, which is looking to sell levels that were solid last support. Sell a level of solid support last, buy a level of solid resistance last. I think FX LAN, I mean, it's a difficult one to answer, but I think that a lot of the time it comes back to when we're analysing at the beginning the groups of people that are doing trades. What happens if you get a solid support level? Okay, got a particularly good one in mind here, but so just roughly here, if you've got a solid support level like this and the market breaks it. Remember, there's people that have missed the breakout that want in on that breakout. The longer it stays out, the more likely they are to notice it on a higher time frame and sell. That's why support, selling support last, works well. Resistance last, you haven't got that same dynamic going on. But I think that, my whole premise about, charts, I try and look for traders to get trapped, to try and take advantage of that in my own trading. But the important thing to remember is that really when you're trading off the chart, we can't see the order book. We don't exactly know what's going on behind the scenes. So you are making, your educated best guess. But it's really important, I think, to look at these areas where people do get trapped and to try and just think a little bit about what are other people going to be thinking here? What do I think even? Like I say, some of my best trades that I've called were areas where I actually was 1 minute was convinced it was going to go parabolic. The next minute I thought, whoa, it's not going to go at all. I realised even I've made a mistake. Think about the cable trade. It broke both. Convinced it's going to tank. And suddenly I think, wow, I was convinced I'm a trader. So a lot of people have been blindsided. Thank you again. Thank you so much for joining. I hope you did find it useful. But we've made a really good amount for charity, and I'm really happy that you guys contributed. And like I say, I hope you enjoyed it, and I'll see you in the free webinar hopefully next week. If you're not on the list for it, just drop me a line. I'll put you on the email list. And like I say, you've got any questions, just fire them over, and I'll do my best to answer them. And look for these patterns, guys, in your trading going forward. Even if you're not quite sure where to put your stops, where to put your targets yet, look for them. Look for the swing failure at swing highs, especially on a breakout. Try and look at a breakout. Is it genuine? These are the kind of things, and just start building that into your conscious mind when you're looking at charts. And I think it will really, really help you. Okay, cheers, guys. Thank you so much.